one of my themes kind of this decade is that I think inflation on average is here to stay for quite a while. But I've also been reiterating that it's not going to be a straight line, most likely. I mean, the 40s and 70s, you didn't have inflation in a straight line. You had disinflationary periods within inflationary decades. And I wouldn't be surprised to see the same thing here in the 2020s. You can get an inflationary spike, and then you can kind of come back down if you start to suppress demand or you fix some of the supply side issues. But until you actually resolve more completely the underlying problem, I think that it's like holding a beach ball underwater. As soon as you let it go, it's bound to want to come back up. That's kind of back in the prior decade, it's like markets had tendency to want to disinflate just because you had overcapacity, oversupply for oil, things like that. And I think we're in the opposite environment now, where the tendency is to want to inflate because we have underinvested in a lot of real assets. And so even though we might suppress that for periods of time, I think the longer term trend is still, probably higher commodity and higher inflation on average than we had the past decade. And so I had that article about the area under the curve. It was actually a friend of mine in market that made that quote, so I decided to turn that into a piece. And essentially, it's the idea that everyone's looking at the price of oil, for example, and they're saying, is it going to go to 150? Is it going to fall down to, is it going to go back down? And my point was that if you're a long-term investor, it's not really about what oil does in the next few months. Whether it's 150 or not, or goes back down to like 80, is irrelevant. And instead, it's about, what is the average price going to be, I think, over the next 5 to 10 years. And so my general theme is that even at current levels, even when oil's at, 90, 100, 120, or if it goes up from there, that is just an ongoing cost for households and for businesses. And eventually you get more and more realignment towards those things. And so, for example, energy pipelines, oil producers, companies like that, even at current price levels and current volume levels with current valuations, they're actually pretty attractive if you look at them out kind of a longer term perspective. And so the challenge with investing in commodities is always that, in the very long term, they're not great asset class compared to what else you get. They're not these like long-term compounders. Disinflation happens more often than inflation. So there are more decades than not where commodities are not great investments. And then even in inflationary decades, you can have some pretty violent volatility among them, even as they outperform. And so I think that having commodities and value-oriented things long term, this decade is probably going to be very helpful, as it already has been. But I think investors have to be prepared for those huge shocks that can come along the way, those downward moves in what is otherwise like an inflationary structure. I think it's very interesting, and I agree with your point that basically people are very invested in disinflationary assets, right? So the 60/40 portfolio, as we know it, is a pretty, it really benefits from disinflation. Generally, it's in the 60 stock side, you're more in growth stocks than value stocks, and growth stocks tend to want a disinflationary environment. And then you have the 40, which is in, paper assets. It's in, again, things that benefit from disinflation. And so what really disrupts, and we've had, 40 years of a downward trend in interest rates, a downward trend in inflation. And out of those 4 decades, I mean, 3 of them were just outright disinflationary, right? So, the 80s, 90s, and the 2010s were all these kind of disinflationary decades. We did have one inflationary decade of the 2000s, but we had so many globalization levers that we could kind of pull so that we didn't really get the brunt of that inflation in the way that we did in kind of prior commodity bull markets like that. And so I do think that, in this period, investors are they have a lot of recency bias built around these kind of compounding things that benefit from disinflation. And I do think that it is good to have some inflationary slices in a portfolio to kind of offset some of those disinflationary assets. It doesn't mean someone has to be 100% in them, but I do think that, just like we saw this year, I mean, stocks and bonds went down together while energy went up. And that was an example of where, it's almost like energy became the thing you want to own that offsets your other stuff instead of stocks and bonds offsetting each other. That tends to be a theme in inflationary types of decades where stocks and bonds are more correlated than we might otherwise like. And instead, it's commodities and real assets that tend to be the diversifier. So if you have a period of inflation, you'll generally have your stocks and bonds probably not doing great, while those commodities are doing quite well. And then if you get a disinflationary pullback within that decade, you could have a period where your commodities and real assets are doing pretty poorly and your stocks and bonds are bouncing back. And so I do think that in a diversified portfolio, having at least a slice towards those real assets or commodity assets or those types of inflationary assets, I think is super useful. And I think that will probably end up being the difference between underperformance and outperformance this decade, is whether or not a diversified portfolio has that slice in it or not. It depends on the type of investor. There are some easy ETFs for people to go to. I know that there's one called Gunner, for example, GUNR. It's like the Morningstar Upstream Natural Resources, I believe it's called. You basically get a big slice of all these different producers from around the world, and it's kind of divided into like energy and then like metals and then like agriculture. There's also like I believe iShares Global Energy ETF. Again, you'll get like a more diversified, multi-jurisdictional exposure to energy companies. I think those are maybe just starting points that someone could consider, and then it depends on what type of investor they are. I think that, say, long duration oil futures are pretty attractive. I think that basically playing the commodity directly can be quite useful, and I also think that the pipelines for energy are pretty interesting. You get a little bit, that whole industry was over leveraged years ago, and it's been kind of bombed out twice now. First in the oil price crash years ago, and then during 2020. And I think the structure that's remaining is now pretty attractive for kind of a yield-based asset. And so I think that there are multiple ways to play it. So I think that there's opportunity right now. I mean, if you go back a couple years ago, we had a lot of monetary inflation that was happening. So the broad money supply went up quite a bit. We saw a pretty broad rise across the board in asset prices. I mean, so it was a very risk-on environment. And with gold investors, it became, why own gold when you could just own all these, if yields are low and inflation's high and money's pouring out, why not own stocks, for example? And then now we're in this kind of like contractionary period, risk off period. Gold is held up better than the broad stock market, but it's really not done as much as I think people hoped. And I think that's in large part because there's a pretty significant quorum of the investment community that thinks the Fed will hike deposit real rates, that will get inflation back under control. We have a very strong dollar at the moment, so gold has actually done pretty decent if you look at it in, say, yen or euro terms, especially in a lot of emerging market currencies, but specifically in the dollar, which is unusually strong right now. It's kind of been lackluster. I think one way to look at it is, there's a firm out in Europe called Incrementum, and they actually had a product that was like gold and Bitcoin mixed together, so that investors could kind of benefit from that volatility harvesting, right? Because if generally Bitcoin does better in these rising PMI environments, rising economic acceleration, and gold generally does better in falling economic environments. And you have kind of almost like a fragmentation of what people want to use as like their hard money holding, right? So you have a lot of people that might have otherwise bought gold, buy Bitcoin, but then it's a very volatile asset. So in other times, some of them might go back to gold. And generally, I think that's kind of the bucket I'm in, where I think if you look at a basket of gold and Bitcoin together, it's actually done pretty well, all things considered. And I think that might be a reason why gold has underperformed, which is that there's so many other assets you can own in that kind of financial oppressed environment, that gold is just one out of many. And what basically gold and Bitcoin have in common is that these are, money that someone can self-custody, for example, that's maybe outside of the traditional system. And so it becomes kind of a competition between those types of assets.